Hi everyone, welcome to Value. So today we're going to look at Affirm and their fourth quarter and full year results for 2021. This came right after the market closed, so the market didn't know what the result was like, but it was still 5% up with some anticipation, and the market clearly loves this because in the after hours the stock was up 20%, as you can see here, at $111. So currently at a $92 pricing, we've got a $24 billion company, and we're going to dive into the result and then see if the results actually justify this valuation of $24 billion or even more. So jumping into the result, Affirm reports fourth quarter and fiscal year 2021 results. In terms of percentage wise, their quarter four growth merchandise volume was 106% up for the year from last year, in comparison to the prior year, which is pretty nice to double what the volume of transactions that have just been going through in terms of the overall dollar value. And in total growth revenue for the fourth quarter was 71% up on year, which is pretty good. They nearly doubled active consumers. If we see right here, it was 97%, up to 7.1 million active consumers, which is pretty amazing. What's even more amazing is they've grown their active merchants by 400%. Growing to 29,000, which is amazing as well. So when we look at the numbers for this company, they are a pretty nice growth company. The numbers sing very well. They just have to continue to execute. There's not a lot of continuous research and development that they have to continue to offer something special. They just have to keep this platform up, keep expanding the features in that sense, and as long as they can attract more merchants for people to shop at, consumers are going to sign up because they want to use the service when they're buying from these merchants. And so it kind of works in tandem. You need the consumers to be on the service to want to buy, and you need the merchants there to be able to sell to those consumers, because if you go to your favorite store and are offering Affirm, you're more likely to sign up for Affirm. But if you go to your favorite store and there's no Affirm service, then you're probably not going to want to sign up with Affirm because it may not be available in the most relevant places. So for Affirm, it's about being in places that everyone more or less wants to be. And in terms of the growth merchandise value, for the fourth quarter, it's $2.5 billion, which is pretty impressive, which was double last year. Though if they exclude the Peloton segment of the GMV, because Peloton makes up a big segment of their sales, the rest of the volume generated was actually at 178% growth on the prior year, which kind of signals that they're able to start diversifying from being too reliant on Peloton, which is quite a good thing. The GMV for the year was $8.3 billion, which was 79% up from the prior year, or 91% if you exclude Peloton. So the minute you exclude Peloton, the growth rates are actually higher. That just shows Peloton is slowed down, and also Peloton just makes up a large segment of the GMV, which kind of makes sense, which kind of makes that Amazon deal quite valuable, because Amazon is a giant that's going to start rivaling these transaction volumes that they get from Peloton. And they're not going to be so reliant on Peloton, whereas Amazon's such a diverse marketplace that it's much better generating your bulk of your revenue probably from Amazon rather than from Peloton, who just sells a certain product to certain consumers, whereas Amazon is used by everyone. So that's probably the more better thing that they've got a deal, though it's non-exclusive, so it means they do face other competition. Amazon could sign up other buy now pay later companies to offer their services on the platform too, so it is not exclusive. So Affirm does have to be on their game to continue to attract more merchants, attract more consumers, to make their platform more compelling. And as they report, they expect for fiscal year 2022 GMV growth to be at least 50% or 70% excluding Peloton. So again, they do expect their GMV to be growing at a very good rate, probably not double, but 50% at least is still pretty good considering they're trying to grow on larger volumes. Though, as they put here, a side note, prior to any benefit from the recently announced Amazon partnership. So with the Amazon partnership, that could actually push those GMV volumes quite a lot more. But they're being conservative and saying at least 50%, which is probably fair. Like, given the company's outlook, sometimes they just don't know these numbers, so they can only give you at least kind of estimates, because no point making big estimates and having to backtrack and say, oh, we're not going to perform as well. It's better upgrading in the future than downgrading later. So yeah, I think they're doing the right thing in terms of how they're going about their guidance to shareholders. So yeah, total revenue 261 million, 71% increase, which is very consistent with the total the full year revenue at 870 million, which is another 71% increase. So overall, they've been growing very consistently at 71% for the year. Their net loss was $128 million, and this compares to profit of last year of 34 million. But 128 million did include 105 million in stock-based compensation that they gave their employees leading up to the IPO in January 2021. So yeah, that's that in that sense, that's a non-cash expense. So if we minus that off to 128, they basically lost 23 million in comparison to a profitable quarter last year of 34. Biggest reasons will be this company's trying to grow as much as possible. They're going to be spending more money. They're going to be trying to keep their staff as well, hence why they want to reward their staff with stock-based compensation. And I think it just creates more sustainability going forward. And it's like, if your platform isn't relevant going forward, if you just stop and go, oh, let's just make profits and not grow anymore, your competition's slowly going to edge you out, and then your consumers possibly might leave to other bigger platforms. So it's important for them to stay relevant by continuing to grow and sign up more merchants and sign up more customers. So the biggest focus currently is on the revenue growth rather than the losses, though you want to make sure the losses do not get out of control, because they want to make sure they have enough money to burn as well. In terms of loss for the full year, it was 430 million, and that compares to 112 million from last year. But 257 million of that was stock-based compensation, so they do give a lot of stock-based compensation out. But in a scheme of things, they are losing about 160 to 170 odd million dollars for that full year, which isn't too bad. These guys, if we go further down, just to answer your question, is it sustainable? Their cash and cash equivalents is $1.46 billion. So I wouldn't be too worried. They've got enough cash to burn, and we're talking about a $24 billion company, so they can easily raise more money going forward without having to heavily dilute their current share base, because like if you raise 10% of that market cap, that would be $2.4 billion. So they could easily raise a good amount of money without heavily diluting their shareholder base. but currently at 1.46 billion, they've got more than enough money to keep them going in terms of the future. In terms of the guidance for the year, the guidance for losses is 145 million to 135 million for 2022. So if they're losing just that amount, then that's not a worry at all. They've got more than enough money to pay for their current losses. The money's probably more likely to facilitate those buy now pay later transactions as working capital rather than to facilitate their losses. But yeah, like if we look at their fiscal quarter 1 for 2022, the loss was expected to be 68 to 63 million, which would be close to nearly half of what their expected losses are for 2022. So the other half of the loss is split over the other 3 quarters. So you can see that quarter 1 is by far the biggest loss-making quarter for them, and every other quarter is either getting close to break even or being a profitable one. In terms of quarter 1 revenues, they expect 240 to 250 million dollars, and for the full year that's going to be 1.16 to 1.19 billion dollars for 2022. And how does that compare to this recent financial year? That will be 870 million. So it's about a 33 to 40% growth in that sense. So it's not too bad. So getting about 30 to 40% growth is still pretty good. Of course, it's dropping from 71%, but it's kind of normal. As these numbers get bigger, they're not going to be able to grow at the same pace, but 30 to 40% is still rather good, particularly given the size of this company. And especially factoring that the losses aren't actually growing that much more, they're actually reducing. So here the losses were around about 160, 170. Here the losses is about 140 to 130. So you can see the losses are lower, but again, these are estimates. These estimate numbers could easily be entirely different once they report next year. But giving some guidance wise, the losses are relatively consistent and very conservative compared to the cash that they hold. So yeah, I'm pretty impressed with the company, and I think everything is in a pretty good standing. In terms of active customers, 2009 they had 2 million, last year they had 3.6 million, and this year they had 7.1 million for the year ended June 30th. So I think they're so far growing at a very, very nice rate. The transaction per customer, this is probably quite a useful metric. They don't look like it doesn't look like it matters as much because it's going from 2 transactions to 2.1. Does that 0.1 transaction matter? Yes, it absolutely does. It actually shows continuous progress. And this year it was at 2.3. So over time, those numbers are really going to add up and show how active this customer is, and they're showing that as the customers are on the platform, they start to become a bit more active as well. And I've just been so impressive with growing their merchant numbers. They're growing them from 3,100 and then growing them to 5,700 to now 29,000 merchants. So as time goes, they're just signing up so many merchants that it just naturally increases the amount of active customers signing up. So yeah, like just looking at this, and I think I'm pretty happy with the result. Especially if you consider that they've cemented themselves. They're on many platforms. They've now got the Amazon deal. These numbers will potentially might even be conservative, because I think not even they can estimate how strong the Amazon deal could be for them. But I guess they'll have to see when time comes. But in terms of the current performance, $870 million and a 24 billion kind of valuation. They're basically more or less looking about 30 times their revenue. So 30 times revenue. Next year if we used a very similar number, but don't mind you, they aren't growing as quick. At 30 times, next year they could be at $33 billion. So if they're going from 24 billion to maybe 33 next year, then the upside is actually really nice, based on a 30 times multiple, especially for a company that's building a very, very strong moat around their business. Of course, there's a lot of competition, but over time, the more merchants you sign up, the more active customers you sign up, it just gives you a very solid position going forward. So they're pretty much will start to justify that, and that's why the share price has moved up 20%, because people are looking at this company and going, if you could be a $30 billion company next year, then there's an upside for me to be in this company, because you're you're a solid company, not quite blue chip, but you will get there in the future. Your business is in a way cemented that you're not going to worry. You're not a pre-revenue company, you're not a startup, you're a giant that's basically continuously growing, and based on the current signs, everything is in place to continue to grow, and I think people feel relieved. This is a type of company you buy into and you can sleep well, because all the numbers are going in the right direction. Of course, they're not going to be extraordinary high flyers in the future. As time goes, the growth rate is going to slowly drop off a bit more, but they will continue to grow at a very nice pace. That compounding effect over many years is going to be beautiful for this company, and any shareholder that's in it for the long run is going to be very happy with the performance over time. Affirm is one of those ones that are of a very high caliber, good quality. There's not a lot of doubts on who they are, all the risks that they have. They've been pretty good performers ever since they've come onto the market. That's my view anyway. Until then, good luck investing, everyone. If you have any questions, post below. Until then, goodbye.